450. That's how many brilliant trading strategies you are mathematically guaranteed to find if you test 9,000 random ones. Not because anything works, because 5% of pure coin flips pass a 95% confidence test. That's not a market insight, it's the definition of a confidence test. Right now, there's a wave of videos where an AI backtests thousands of strategies and shows you the winners, and the winners look incredible. Today, the 4 pieces of math those videos skip, the receipts from the people who checked, published by mathematicians, regulators, and brokers themselves, and what betting actually looks like when someone has a real edge. The format is always the same. An AI generates or scans thousands of strategy variations, moving average crossovers, momentum rules, candlestick patterns. Each one gets backtested against historical prices. The bottom 90-something% quietly disappear. The survivors get a beautiful equity curve going up and to the right, an impressive win rate, and a sharp ratio that's return per unit of risk that would embarrass a hedge fund. And to be clear, the AI did run those backtests. The numbers on screen are usually real. The problem isn't the arithmetic. The problem is what selecting winners from a huge pile does to the meaning of the word winner. Here's the coin flip version of the whole industry. Give 9,000 monkeys a trading terminal, every monkey trades at random. After a year, roughly half beat the market, pure luck. Rank everyone, take the top slice, and a standard 95% statistical bar, 450 random strategies pass as significant. Their backtests are spectacular, their true edge is exactly 0. There's a classic scam built on this. Email a stock pick to thousands of people, half saying up, half saying down, keep emailing whoever saw the correct call, and after a few rounds a small group has watched you be right 5 times straight. Selection did all the work. AI just industrialized the selection. Don't take my word, take the mathematicians. This paper ran in the notices of the American Mathematical Society, and the title is not subtle: Pseudo-Mathematics and Financial Charlatanism. The authors proved how little searching it takes to fool yourself. With 5 years of price data, trying just 45 model configurations is enough to expect an in-sample Sharpe ratio of 1, a genuinely good number, from strategies whose true out-of-sample Sharpe is 0. 45 tries. The videos run thousands. And the authors go further, not reporting how many configurations you tried before showing the winner is, quote, a similar kind of fraud. Count how many of these videos tell you that number. And before anyone says this is just a YouTube problem, it happens to professionals with peer review. Campbell Harvey and co-authors cataloged 316 market-beating factors published in academic finance journals, and showed that, after correcting for all that collective searching, the standard significance bar is worthless. Their fix, a new discovery shouldn't be believed below a t-statistic of 3, a far higher hurdle, and their conclusion, printed in the abstract of a top journal, is that most claimed research findings in financial economics are likely false. That's the failure rate with tenure committees and referees. Now remove the referees and add a subscribe button. Piece 2 of the missing math. The backtest trades for free, you don't. The classic evidence is Barber, an Odean study of 66,000 real brokerage households, titled Trading is Hazardous to Your Wealth. The households that traded the most earned 11.4% a year, while the market returned 17.9%. Here's the beautiful part. Their stock picks were fine. Gross returns before costs were nearly identical to everyone else's. The entire 6.5-point gap was friction, commissions, spreads, timing. Commissions have since gone to 0, spreads and slippage haven't, and high turnover strategies, which is what these AI screens overwhelmingly produce, are exactly the ones friction eats alive. Piece 3. Survivorship measured on real humans. Researchers got the complete records of every person who started day trading Brazilian equity futures over a 3-year window. Everyone, not just the ones who later posted screenshots. Of the people who persisted more than 300 trading days, the committed ones, the ones putting in their 10,000 hours, 97% lost money. 1.1% earned more than minimum wage. Half of 1% earned more than a bank teller. The lesson isn't that those people were stupid. It's that you only ever hear from the 1%. And an algorithm that shows you only survivors is the same trick with better production values. If you want the same number from an unimpeachable source, here's my favorite receipt in all of finance. European regulators force leveraged trading brokers to publish their real customer outcomes on their own websites. This is IG, one of the largest in the world, and that banner says 69% of retail investor accounts lose money trading with this provider. That's not a critic's estimate. That's the casino legally required to print the house edge on the front door. The business model works anyway because the marketing sells the 31%, and every AI strategy video is, functionally, marketing for this exact activity. Piece 4. The base rate for people doing this with every advantage. S&P publishes SPIVA, a scorecard comparing every actively managed U.S. large-cap fund, professional managers, Bloomberg terminals, research teams, against the plain S&P 500 index. Over 1 year, 73% of them lose to the index. Over 10 years, 86%. Over 15 years, 88%. And if you adjust for risk, 98%. These are the people the AI strategy pitch implies you'll outtrade from your laptop. The index fund isn't the boring option in this comparison. It's the 98th percentile. Now run the expected value check on the seller because incentives are the mechanism. Suppose you found a strategy with a real edge. Real edges have capacity. Publishing one destroys it. A fund would pay you millions to keep it quiet. Selling it as a $99 course is the worst monetization available, unless the strategy doesn't survive contact with reality, in which case it's the only monetization. The SEC knows the pattern. It fined advisors $400,000 for faking AI, and its marketing rule classifies backtests as hypothetical performance, too misleading to show retail clients. A regulated advisor could not legally show you what these videos show you. So what does real quantitative betting look like? In 1956, John Kelly at Bell Labs derived how much of your bankroll to risk when you actually have an edge. The Kelly criterion, bet your edge divided by the odds. Two things are the entire lesson. First, the input is your edge, and if it came from an overfit backtest, your true edge is 0, and Kelly says bet nothing. Second, the formula punishes overconfidence. Thorpe and colleagues proved that betting double the Kelly fraction cuts your long-run growth to 0. Professionals bet half Kelly because they don't trust their own estimates. The videos assume an edge, measured with none of that humility. Here's the checklist this channel owes you. Any strategy pitch, AI or human, answer 4 questions before a dollar moves. How many things were tried before this one if they won't say? The mathematicians call that fraud their word. Was it tested on data it never saw, truly out of sample, not tuned and retested? Do returns survive real costs at your account size? And what's the seller's expected value for telling you? If the answer is course sales, you have your answer. Against all 4 stands the null hypothesis. The index fund that 98% of professionals can't beat on risk-adjusted returns, available for 4 basis points, no subscription required. None of this says AI is useless in finance. It says selection bias scales better than edge, and the arithmetic doesn't care whether the selector is a monkey or a model. This is mechanism, not advice, and every paper, scorecard, and fine from today is linked below. Read them. They're better than the videos. If you want the follow-up where we derive the Kelly criterion properly and show why professionals bet half of it, subscribe. Your money deserves the boring math that's actually true, receipts included.